Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Snapping cables. We've already seen the British pound pounded in a very, very big way. If you notice, if you go back to your charts, the British pound was the major currency that broke first against the U.S. dollar. It broke pretty much in line with the beginning of the credit crunch. The reason that is, again, with the gift of hindsight, is the British economy or the UK economy was more leveraged to the global financial system or financial services than any of the other major economies. That means its growth was leveraged to that. A lot of the derivatives and a lot of very, very smart people live and work in London, creating a lot of sophisticated derivative products. That was an inordinate amount of growth that it created because of high disposable incomes. And sure enough, as the credit crunch hit, the pound was hit first because the financial services sector, which is a big driver of British economy and GDP, just fell off the table. And people also started to realize that the disposable debt relative to the income of the UK consumer was massive and even a lot higher than the U.S. So the British pound has broken in a very, very big way. It's stabilized here in this range right now, and it's bounced up nicely lately. But UK government's in trouble. Prime Minister Brown's in trouble. Their budget's going to come out tomorrow, I believe, and they're going to be breaking the bank there. We're going to see probably some nationalization more nationalization of the banks. But what's new? It's basically de facto nationalization in the U.S. too. But we think the system continues to be in trouble because we don't think you're going to see the type of liquidity rebound in the financial system and drive financial services growth as it did before. How does all this transmit into dollar strength? Again, we'll go back to commodities correlation. Again, these correlations can break down at any point in time, so you have to be careful. You don't know who leads or who follows, but it's been a fairly tight correlation. Again, back to the U.S. dollar index, the red line, beginning of the bear market. Notice where commodities were then. Notice how the U.S. dollar, U.S.-based credit funding the globe, and commodities rocketed. Commodities topped exactly when the U.S. dollar bottomed on these charts. And we're seeing this mirror image correlation play out. We think eventually all paths will lead back to 2001, maybe beyond, meaning to the point where where the commodities market took off in a liquidity-driven cycle. Sure, there was massive demand from China, and there were some real drivers for commodities, and there were some real reasons in terms of supply and demand for commodities to move up in price. But a lot of this was liquidity-driven in a very big bubble by massive amount of U.S. dollar-based credit flooding the world. If we return to the 2000 where they took off, that means commodities fall another 30%. We got another 30% fall in the commodities index. And if that's the case, and we return to the, again, using this chart as a correlation, and it's never this simple, but if we do, we're back up to 120 on the U.S. dollar index where this dollar bear market started back in 2001. This correlation's been very tight. And again, a lot of the driver of this correlation is China and the emerging markets, the driver of commodities. Second point, final capitulation, as I said, out of the emerging markets. If we see that, the first run we saw out of emerging markets, it triggered a lot of flow back into the U.S. People were scared. The U.S. is the reason the U.S. dollar benefits when the globe is worried. The U.S. dollar is the world reserve currency. We have the deepest capital markets in the world. And if you want to hide $100 billion or $200 billion, or you can't hide that in the Malaysian bond market or the Chinese money market, you have to go into the U.S. Treasury market to hide that kind of money. So ultimately, currency prices are driven by one thing. When you break everything away, it's capital flow, global capital flow. Regardless of what we see in terms of what's going on in the economy, the real key is what's going on underneath the economy. money flow. And when the emerging markets broke for the first time and everybody panicked, a lot of the money flew into the U.S., and that's why we saw that massive move in the U.S. Treasuries. People are moving into the U.S. to hide, not because they love the U.S. dollar, not because they love anything that basically is going on in the U.S. economy, but they can't hide that pool of capital anywhere else except for the U.S. capital markets. So to do that, they have to buy the dollar to buy U.S. Treasuries, and that's why you see that corresponding move. Emerging markets could be Euro's Achilles heel. This number, obviously these numbers have changed, but this is a number we got from a place called Leader Research who does some wonderful stuff. And when we saw this, we kept thinking this number cannot be true, and we kept going back, and sure enough. If you look at bank loans to emerging markets, September 2008, okay, this is just private bank loans to emerging markets. 4.6 trillion, okay, that's a big number to emerging markets. Of that 4.6 trillion, 3.7 trillion comes from European banks, and only 475 billion from U.S. banks. So when people tell you that the U.S. banks are in a lot worse shape than the European banks, keep this number in mind. The Eurozone banking system is incredibly exposed to emerging markets, and the emerging markets have been hit very, very hard. And this is why the IMF is running in to try and prop up emerging markets, because they know the Eurozone banking system is incredibly exposed. Italian banks, Swiss banks, Austrian banks, Greek banks, UK, I mean, you name it. And that's one of the reasons also we don't think the Swiss franc is playing the safe haven role that it did in the past. It has a massive amount of exposure on its books still to the emerging markets. A lot of these emerging markets in Central Europe especially took out very low interest rate loans denominated in Swiss francs in order to fund a lot of real estate investment and all just to get private mortgages. Well, that game has changed. The credit has fallen away. The international banks are no longer lending to these emerging markets, and now they're stuck with foreign exchange loans in Swiss francs that are appreciating against their own currencies, the Hungarian forint, the Polish zloty, the Czech koruna, which are falling off the table relative to the Swiss franc, putting more and more pressure on borrowers in these Central European countries, and more pressure on this exposure in the Eurozone banking system. The G20 summit that we just had, there was a lot of things said about the G20 summit, but ultimately underneath it, if you shake everything away, the G20 summit was about saving the Eurozone banks, and that's why Sarkozy and Brown were putting so much pressure on the U.S., on President Obama, to step up and provide all this new funding. They need to save the Eurozone banking system. They talked about this and that, but that's the driver here. The IMF is doing what they can, but there's only so much money available in the world. So if we see another breakdown in the emerging markets, we think this exposure, which may be less than this now, needless to say, a lot of deleveraging has taken place, but the relative exposure we're trying to make from the emerging market problem for the Eurozone central bank, which means the euro relative to the U.S., is huge. Okay, say you buy into this story and you think it makes sense and we're starting to see this play out. I wanted to give you an example of how to play this using the long-term call option, a euro call option traded on the ISE. As Steve said in the introduction, these options go out to 10 months. I mean, you can go out to March of 2010, which again makes this a great product to make a long-term bet on the global macro economy with an amount of leverage for a very small investment. You can't get that kind of play in the spot market or the currency futures market. You can get it here, and again, get it for a fairly low price and make a small bet. And if these things play out as I said, who knows? Maybe we get it right. This could be a nice little gain. I just want to show you the example. And again, this is an example, and this is not a recommendation per se.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.